This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're now going to look at Chapter 10, Budgetary Control and Performance Management. And certainly the first half of this chapter is very much revision of paper P1. So I shouldn't need to spend too long on it, although, as always, do make sure you read through it properly yourself. But we all know what we mean by budgets in general, that most businesses, certainly once a year at least, will prepare a budget for next year, a plan. But a few general things. First of all, appreciate what the objectives of budgeting are, why we're doing it in the first place. And different businesses make different uses of the budgets, but the standard objectives of doing the budgets are those listed in paragraph 2. That planning, the word budget means plan, that we need to plan exactly what we're going to do next year. How many are we going to produce? How much labour are we going to need? How much materials we're going to need to buy, and so on. Although ultimately, normally, we end up with a budgeted profit statement. I keep saying for the year, it doesn't have to be, but most normally. Although we normally do end up with a budgeted profit statement and statement of financial position, whatever, really, it's made up of a whole series of little plans. Human resources need a plan. How many employees do we need next year, and so on. Communication. Communication in two ways, in two forms. One is obviously effectively telling the relevant managers what's expected of them. Human resources, again, if we've told them, if we've planned, if it's in the budget, we need 500 employees next year. Well, the budget is communicating that fact to them. But it's also communicating where the business is going, what the business is trying to achieve overall. Coordination. Another reason for needing a budget. Our production department may think they're capable of producing 20,000 units a year. But if the sales department think we can only sell 15,000, well, it's clearly not much use in producing 20 if we're only going to sell 15. The budget process helps us coordinate, that we are producing what we think we can sell, that we've got the right number of staff for the level of production, and so on. Motivation. We'll talk more about this later, but if the budget's handled well, hopefully it motivates our managers in order to achieve or even to beat budget, gives them a target. Authorization, delegation. Sorry, I'm making a bit of a mess here, keep putting in big circles, but still. Authorization, delegation. Sorry, keep using human resources, but if we've agreed the budget that we need 500 employees, well, that authorizes human resources to make sure we've got 500 to recruit extra if needed. If I'm in charge, they only need to come back to me if for any reason they decide, we need to recruit more than 500. And delegation, it then becomes their responsibility to achieve budget for their department. Control relates very much to variances, which again you should have seen already, but gives us something to compare with. We may have budgeted on spending 5,000 a month on materials. If it turns out when we actually start going through the year that we're spending 6,000, there may be very good reasons for it, but we need to know why. We need to investigate why are we spending more than we were planning. And finally, evaluation of performance. Our managers. The budget, I said earlier, effectively becomes their target. If they do better than budget, they've done well. If they do worse than budget, perhaps they've done badly. But we've something to measure against. Exercise 1 is really more for you to think about. It says consider budgets that you may have experienced in your workplace or elsewhere. How successful were they at fulfilling the objectives, obviously I'm not capable of saying how it worked in your workplace, but have a think about those objectives, think down them. How can budgets be used as a motivational tool? Well, I mentioned earlier, the budgets for each department, for each manager, become their target. And it doesn't mean that we have to be careful setting the budgets. We have to make sure that they're realistic and demanding, but that they're not ridiculous. You know, and just a simple example, if we are budgeting that, labour costs should be 5,000 a month, and the person in charge knows that's completely impossible. There's no way it could be 5,000. It's going to be at least 6,000. Well, the manager doesn't even try and make budget, just gives up completely. There's no motivation there at all. On the other hand, if 5,000 is a reasonable, achievable target, without being what you might call too easy, well then they're hopefully a lot more motivated to try and achieve it. To what extent does the budget enable communication of objectives and future plans? I mentioned that briefly a few minutes ago. That by looking at the budget, it gives the manager an idea of where the company is trying to focus this year. Maybe this year we're putting a lot of effort into improving quality. Or maybe this year we're introducing some new products. Well, the budget helps communicate that sort of objective. Over the page, principal budget factor. How are we going to start preparing the budgets? We can't just jump in and say, let's do a telephone budget or something. We've got to have a starting point. And for most businesses, the starting point would be sales. Because it's only when we know how many units we're going to sell that we can then start deciding how many we're going to produce. And only when we know how many we're going to produce can we start deciding how much material we need, and so on. And I say normally sales would be the starting point, but the starting point, the first thing we need to budget is the factor that limits the activity. And I've said twice, usually that's sales. There's a limit on how many we can sell, and it's that stops us being any bigger. But you could have a situation where maybe I produce desks and I'm capable of selling 50,000 desks a year, the demand. But perhaps this year there's a limit on the supply of wood available. And for some reason, we can only get hold of enough wood to make 20,000 desks. Well, in that case, it's the supply of the wood that's limiting how big we can be. And so we first have to budget how much wood could we get. Then we can budget how many we're capable of producing. Then we can budget how many we're capable of selling. So that's principal budget factor, and any business has to think first of all, what is it that's limiting us? Albeit, as I said, it's usually going to be sales. And then, of course, we can, I'm sorry, I'm trying to get it to scroll, it's decided it doesn't want to. Oh, there we are. Then we can carry on and prepare the other budgets, as I mentioned before. So you can see the sort of pattern there. Assuming sales are our principal budget factor, budget the sales first, then we can budget how many we're going to produce. Maybe we produce more because for some reason we want to build up inventory. When we know how many we're producing, then we can do a raw materials budget. How much labour do we need? What the overhead's going to be? We can put them together, bring in other expenses, and then normally do end up with a budgeted income statement. Not automatically, but most commonly, you'd also have a capital expenditure budget. so that you could put them together and do a cash budget, generally month by month, just to check, are there any months where there's going to be a cash shortage and maybe we might need to do some borrowing. And finally, a budgeted statement of financial position. So just the idea of it step by step by step. And all of these, what you might call functional budgets, raw materials, for instance, isn't just a dollar budget. You'd be budgeting how many kilos of material or how many square meters of wood do we need. So there's a budget in that form. And then, of course, you'd cost it out to be able to produce a cost of goods sold and a budgeted income statement budget. So that's where we're going anyway. Over the page. Be happy, I hope you already are, but be happy with those terms: fixed budget, flex budget, rolling budget. A fixed budget is what you might call the original budget that most companies prepare. Maybe November, December, they do a budget for next year for 12 months. So that's your original budget. Obviously, that budget's going to go out of date. However well you might try and budget, things aren't always under our control anyway. You may have budgeted on increasing wages next year by 5%. Market forces may end up forcing you to increase wages by 10%, and immediately the budget's what you might call wrong. Now, I know a lot of companies periodically go through and update the budget for that sort of thing. But the important thing about this fixed budget, suppose I budgeted on a profit next year of 100,000. We start going through next year and suddenly find there's high inflation. We've had to put wages up, and putting wages up is going to cost us an extra 10,000. I'm not going to hit budget. Well, we don't just lie back and say, oh, what a shame. Profit's going to be less than we were forecasting. Surely the original budget profit, that remains our overall target. And if we suddenly find out we're having to spend an extra 10,000 on wages, we'll look for any way we can of saving 10,000 elsewhere. We don't just accept it and forget it. You know, the fixed budget, certainly the final budgeted profit, that remains our target for the year. The flexed budget, well, one problem with the fixed budget, we may have budgeted spending 5,000 a month on materials. Maybe, though, next year we end up producing more than we originally intended. Maybe demand's higher, we produce more, great. And therefore, clearly, we're going to spend more than 6,000 a month on materials. But I mentioned earlier, the budget's used for control. So, you know, to measure how well the manager's doing, we compare the actual expenditure with the budget. But it is stupid to say, you've spent 6,000 on materials, it should only have been 5,000. If we've produced a lot more, clearly, if you produce more, you expect to spend more. And it's only sensible to compare the manager on what they've actually spent as against what you'd expect them to spend on the actual level of production. And so I'll remind you with some numbers in a minute to make it perfectly clear. For the flex budget, we revise the budget, generally tends to be done monthly, but rewrite the budget for the actual level of activity, and then we compare what actually happened with this flexed budget. Actually, I'll come back to that in a minute with a quick little example, if you're the slightest doubt. Finally, the rolling budget is wonderful. Although some people get rather frightened by the idea, but I'll explain. What a rolling budget is that perhaps in December, we do a budget for the following 12 months. So in December, can't even spell it. In December, we do a budget for January to December next year. But then instead of waiting the whole year before we do the budget again, in January, we again do a 12-month budget, but this time we budget from February through to January of the following year, so for the following 12 months. And similarly every month, so in February, budget again for the following 12 months, budget for March to February in the following year. And so every month you're doing a budget for the following 12 months. Now that sounds horrendous, except of course, appreciate you've done a budget from January to December, and so when you come to do the budget for February to January, you've already got February to December, and okay, you may need to update it, prices may have changed. So you're updating February to December and then adding 1 month. Now the benefits of that are twofold. One is, I think you'd agree, it does mean the budget's always more up to date. It's going to be more accurate. Every month you're updating and adding a month. But secondly, although it seems a lot of work, in fact, people get much better at budgeting. It becomes part of a normal job. You see, I don't know to what extent you individually may have been involved in preparing budgets, but businesses tend to do it once a year, and it all has to be done against a deadline. People are working overtime, trying to get the budget finished. And then a year later, they come to do it again, and they've forgotten how they went about it the year before. A lot of time's wasted. And because they tend to be so often doing it in a rush, however hard they're trying, inevitably, afterwards they'll say, oh, why did I do that? I could have done it better. Whereas with rolling budgets, because you're doing it every month, it becomes part of your normal work. All right, 1 or 2 days a month or whatever, you start to allocate time to do it, and you get better and better at it. If you're doing it every month, you remember what you did the previous month. You're not sort of having to relearn the exercise. So it does lead to better, more accurate, more realistic budgets. I said we'd have a quick check on flex budgets. A very easy example here, but we will. We give them there our fixed budget. Our original budget was to sell and produce 10,000 units. We were budgeting on materials 50, labour 25, and so on. Selling price $10 a unit. And at the end of the year, the following costs had been incurred. And I hope very obviously, as I said before, if we're using it to measure performance, to say, we've spent 60,000 on materials, the budget said 50, why have we overspent 10,000? Or to tell the relevant manager they've done a bad job. That would surely be insane, or unfair at any rate, because the budget was done on producing 10,000. We actually produced 12. And obviously, if you produce more units, you'd expect the cost to be higher. It's not the materials manager's fault that we've produced more. And so when we're using it for those purposes, we rewrite the budget or flex it. And can I fit it in here? Yes, I can. I'll do it on this page. That original budget was for 10,000 units. We actually produced 12,000 units. And so how much? Let's rewrite the budget on that basis. As far as costs are concerned, If it was 10,000 for 50,000, sorry, 50,000 for 10,000 units, we were obviously budgeting on $5 a unit. For 12,000 units, you'd expect therefore to spend 12,000 at $5, 60,000. Labour, 25,000 for 10,000 units, that was budgeting on $2.50 a unit. Well, produce 12,000 units. Surely, at $2.50 each, we'd be expecting now to have spent 30. And similarly variable, 12,500, that's $1.25 a unit. For the 12,000 actually produced, 12,000 at $1.25 is 15,000. Now I think it says at the at the very bottom of the question it says use the marginal costing approach. Fixed overheads, of course, by definition should be fixed, and so we'd still be expecting them to be 10,000. The selling price, the revenue, well, the original budget at $10 a unit, 10,000, was 100,000. The flexed budget, 12,000 units at $10 a unit, you'd be expecting 120. So that just total it up. The total costs we're now expecting to be 60, 90, 115. And although it's more than's actually needed here, 100,000 pounds, we were budgeting on a profit of 2,500. The flexed profit, 120 minus 115, 5,000. So not terribly pretty here, but because I'm swatching it on the page. Why have we flexed it? Because now we can look at what actually happened. Sorry, that was the flexed budget. And what did we actually spend? Materials, we did spend 60. Labour, we spent 28,500. Variable 15. Fixed 11. So a total of 60, 88, 98. No, start again. 1, 6, 14, 1, 7, 9, 10. I think 114,500. The revenue, we sold 12,000 units for 122,000. And so the actual profit, 7,500. Well, now, for the purpose of measuring performance, we can compare and look at the differences. The differences or the variances. Direct materials, spot on. Although we spent more than the original budget, it's because we produced more. The manager is exactly on budget. Direct labour, again, we spent more than the original budget, but we've actually done well. We've saved 1,500, a favourable variance, based on the actual level of production. Variable overheads, again, exactly as they should have been for the level of production. Fixed overheads is the problem. We've overspent by 1,000, adverse. And of course, revenue we've gained because of higher selling price, a favourable variance. And of course, we now know why the profit's different. We expected originally to make 2,500. The most obvious reason for the actual profit being different is that we sold more. And for the 12,000 we sold, we should have made 5,000. So that's accounted for 2,500 extra profit. Why didn't we then get 5,000? Well, we saved, we lost. Saved, lost, saved. Overall, we gained, what is it, 2,500. So from the original fixed budget of 2.5, we gained 2,500 because we produced and sold more. We gained another 2,500, partly due to labour, for some reason, doing well and saving money. Sales department somehow managed to get a higher price, lost a bit of it, because whoever's in charge of fixed overheads, we seemed to overspend. Okay, one more bit before I have a break. In that, over the page, methods of budgeting, incremental, zero-based, activity-based. Now, again, partly because this is written in full, and I think it's written quite well, and because you should have seen it before, I don't want to spend too long. I'm not sent on to read every word. But incremental budgeting is the most obvious way, and perhaps the most common way of budgeting. That if I asked you today to go away for an hour or two and come up with maybe a trivial example, but I don't care, to come up with a telephone budget, what you'd probably do is you'd look to see how much we spent last year, and then you'd adjust it for two things. You'd adjust it for any expected inflation. You'll say, oh, do I think they'll put the prices up this year? Yes, 2%, right, you'd add on a bit. You'd adjust it for any changes in level of activity. You know, if we've got more staff, you may budget a bit more. If we've got fewer, maybe a bit less. But basically, incremental is taking last year's figures and adjusting for inflation and for changes in the level of activity. Which is fine. I say it's the most common way of doing it. It's the most obvious, perhaps. And I was going to say it's relatively easy. I'm not saying it is easy. But it can be done reasonably quickly, generally. However, zero base, in principle, is much better. Still using telephone. I'll give you a better example afterwards. Maybe at the moment, our telephone is all fixed line, landline. It always has been. And with incremental, we're assuming it will be next year. You know, we're just adjusting for inflation or whatever. But of course, just because we've always just had a landline doesn't mean we have to stay that way. And for two reasons. There may be other companies provide landline other than the company we use. An alternative, though, maybe would be scrap the landline and give everyone mobile phones instead. Or, again, maybe scrap the landline and use internet phone, things like Skype. There are alternatives. And isn't it time that somebody sat down and said, what alternatives are there? Stick with the landline, give everyone mobiles, use Skype. And actually worked through, costed them out, and decided which was the best, which was the most efficient, which was the cheapest. And maybe we end up deciding we're best off staying with landline. Maybe we switch to mobiles. But somebody should sit down sometime and look at these alternatives and decide. And the time we should do it is when we're budgeting. We're doing our plan for next year. That's when we should look at these alternatives. Now, telephone may be trivial. What about I'm a desk producer? We've always made the desks by hand. We've been making them for 100 years. And if we produce a budget incrementally, we'll assume we're carrying on making them by hand. And when I come to do a labour budget, it takes an hour to make them, we can't get any faster, add on a bit to the wage rate. There we are. But maybe these days we could use machines to make the desks. And again, somebody should sit down and say, well, let's cost them out. What will it cost us if we make them by hand? What will it cost them if we make them by machine? You know, we'll look at other factors, quality and whatever. But somebody should sit down and decide, what are the alternatives? By hand or machine? Which is the best alternative? Stick to the hand, change to machine, and then do the budget. And that's zero-based. So I think the idea behind it, I don't think anyone can disagree, it's a sensible idea. We should periodically be looking at, can we do things differently? The problem, of course, is it's going to be very time consuming. It takes a lot longer than incremental. And also it needs expertise. You see, who's actually going to do this costing out? Think about making desks. The production manager, he knows all about how we make desks. I don't. I'm an accountant. I'm nowhere near as knowledgeable about the actual production process. But on the other hand, the production manager is not an accountant. You can't expect him or her to do the costings. I'm the accountant. And so it does need this expertise. It needs us working together. It has to be teams of people doing on it, the accounts department and the production people, which again takes time, and time costs money. And so companies who do use zero-based, what they tend to do is each year do one area of the business zero-based and do everything else incremental. So this year it may be, shall I make desks by hand or machine? We can direct, or extra personnel working on that area. The rest of it's incremental. Next year, well, whatever we decided to do about making desks, we'll do that bit incremental. We'll turn to another area, maybe telephone next year, and do that bit zero-based. Finally, activity-based budgeting. You've done activity-based costing, and in fact we revised it in an earlier chapter. And so it's taking the same approach, but budgeting, looking at the activities, focusing around the activities, and budgeting them. What's involved in that activity, how much is it costing, what's driving it, and budgeting from that side. Okay, we'll have a pause there. In the next lecture, I'll carry on with behavioural aspects and beyond budgeting.